Hello, everybody. Welcome to this webinar brought to you by Bursa Malaysia and managed by our company LifeChamp. Our webinar title today is Navigating Through Red Flags in Corporate Governance on Bursa Malaysia. Thank you so much for joining this session. My name is Shane Chu. I'm the moderator for this webinar. Now, corporate governance plays an important role in governing a public listed company so that it operates in a transparent and responsible manner so that it protects the minority, the interests of the minority shareholders. So today we're going to go through what are the nitty-gritties that we need to know when it comes to evaluating the board of directors, the senior management, and also evaluating the corporate governance. All right. So as usual, disclaimer, whatever we share in this session is only for educational purpose. In no way that I give any recommendation for you to buy or sell any listed securities that we mentioned here. If you decide to make any investment decisions, you're 100% responsible for all your investment risks. Now, allow me to introduce our speaker today. He first indulged himself in the SME financing industry right after finishing his diploma in finance and investment in TAR UMT. So he continues to pursue his interest in finance and capital market by joining Rakuten Trade and TA Securities, which he held the position of risk and compliance officer, as well as dealer representative at TA Securities. So to date, he has over 7 years of experience in the capital market as an investor himself, where he also runs One to Invest, a financial blog, which amassed over 60,000 followers to date. He is also the investment associate for a private equity firm, Sensuria Capital Sdn Bhd, and currently he is also an SGX Academy speaker. So he's none other than Mr. Max Tan. So Max, how are you today?
Hello, Shane, and good evening, everyone. I'm fine. So hopefully everyone is doing well in the quote-unquote bull market over this month.
Well, good. Yeah, today we are very pleased to have you here to share with us your experience in evaluating companies' management as well as study the corporate governance. So we can't wait to hear from you, Max.
Thank you so much, Shane. Hi, see you. Good evening. Okay, one moment. Let me share my screen for a bit. Okay, so again, good evening, ladies and gentlemen. Pardon me if my voice is a bit off because I just recovered from a bit of fever. But thank you very much, LifeChamp and Shane, for having me tonight. And again, once again, warm welcome to everyone to our session tonight on the topic of navigating through red flags in corporate governance on Bursa Malaysia. And once again, my name is Max, and this topic is quite serious. And a lot of investor terminology might feels like very foreign. What exactly is this corporate governance? Or is it something too savvy to understand? I try to make it easier to digest. But to me, before we actually start, the terms of corporate governance under a formal set of what we call the definition is actually a set of system, a set of rules, some of the practices and also processes that a company run on how do they run a company. Okay, if you put the word as a Malaysian, terbalik the words, it's actually how do they govern their corporate, right? But today's keyword I want everyone to try to remember is actually lies on the term interest. This interest is not your typically what we call it's a bank interest, but this interest is actually for a public listed company or the management of a public listed company to strike a balance between the interests of all the stakeholders. So all the stakeholders includes shareholders, the management themselves, board of directors, customers, suppliers, financials like the banks and government, and of course back to the community. So needless to say, we are going to talk about some of the bad corporate governance example that led to a sour performance in share price. Some of you here might be the unfortunate victim of some of the companies here. And I would really greatly appreciate if you have any companies that you would like to discuss. please don't let me know what company you are asking. Just tell me the scenario. Just tell me what do you think about the company, what is actually going on. That's it, right? We will try to discuss that company from whatever information you provide me without knowing the name. I do not know, I do not want to know the name. So I am still very keen to work long term with LifeChamp to, continuing having webinar sessions. So hopefully, after the session, if I accidentally mention any funny names, hopefully I will disappear. Okay. Again, I think quick disclaimer. So I myself, I'm a marketing representative for TS Equities, Momo, and also iFast Capital. By all means, I'm not a licensed person to give you any form of advice. So in the event we mention any company names here, it should not be treated as a buy, sell, or hold solicitation or calls. Okay, so please consult someone professional or someone licensed if you want proper investment advice. Okay, so this is about myself, but I think Shane has introduced me, so I'm not gonna repeat it anymore. Right, so without further ado, let's jump into the key topic. So again, we're back to the word interest. When we talk about corporate governance, a lot of times the first thing that we would identify in abnormalities or funny thing going on for a public listed company because of lack of proper corporate governance, normally the first thing we'll see is a share price anomaly, right? You see, let's talk about the definition of a share price of any public listed company. Under a normal circumstances, right? Under a normal demand and supply scenario, the share price is usually a natural reflection of a company's valuation. So albeit the market, you and me, we might have different kind of valuation attached to a particular company. Hence, you see market go up and down, right? But for an established company or a company with a stable or sustainable kind of valuation ongoing, normally the share price would not have a too big of a deviation on the share price. So as the one that you can see here, again, no names being called, you can see that there's a significant price upwards and then significant downwards in share price. And after some years, suddenly the share price went up in the earlier of this year, and suddenly it crashed down. So if we have the time, we will talk about the scenario in January and February, what happens to the capital market if you have the time by the end of the session, right? So generally speaking, the market, right, the liquid nature of this capital market is that we are able to buy and sell shares at the tip of your finger. No longer we have to go through a remiser, then we have to get the paper certificate. Nowadays, you can buy shares if you want to go through your remiser, just text them or call them or just log into your app, right? So at the ease of liquidity, sometimes it comes of a potential of triggering a lot of conflict of interest, especially at the era of time where transmission of information is so easy, right? The easier it gets, the easier that conflict of interest would appear. So there comes a lot of intention from a lot of parties, whether ill-intent parties, I would say, to profit from not properly running the business, but from the profiting from the capital market itself at the expense of minority shareholders such as us, right? And normally, right, if you see this term before, UMA, probably you're in the market for some time already. Normally, any significant movement in share price without a proper explanation, our exchange would actually warn investors. How? They will issue a unusual market activity note, UMA note, to warn everyone that, hey, we noticed something is unusual about the share price movement of this company, whether it goes up or it goes down. So for example, at the one you see here, it spiked up and then it crashed down afterwards, right? I think through the UMA, investors are now more cautious than ever than last time, especially again, with the ease of information to access. But all the time, right, we are human. We are prone to different kind of emotions, right? So there are incidents where external forces, again, I mentioned just now, definition of share price should be a normal reflection of the company's value, but there are sometimes external forces that trying to move the share price beyond the valuation of the company. And whenever traders or some investors, they see the share price moving so significantly, more or less they will get attracted and they will be tempted to trade, right? And ultimately, so these investors or these traders might get trapped in between. And as you can see here, this stock, particularly in the Q1, has actually gone limit down, I think 3 or 4 times over the period, or close to limit down during the same period. Okay, so the first way to look for red flags in public listed company on Bursa or whatever exchange you're going for, but in Bursa specifically, try to look out for any UMA has been issued by the exchange for the past year, right? And we'll talk about after what happens after the UMA later on. So nowadays, if I'm not mistaken, some of the brokers, they also offer a pop-up warning for significant move in share price in the app or on the platform, right? But sorry, can we say that UMA generally is a bad thing happens for the companies? Okay, I would say UMA itself doesn't represent any good or bad, but it is to create an awareness for all the investors, right? It's not trying to define whether, okay, you got UMA, you are a bad company. No, it's trying to give you an awareness to look deeper into the company, okay? So when you see any UMA, one of the first assessment that I will do whenever I see UMA, just use any tool online. I think they're free. A lot of tools now, a lot of broker offer free tools. Look at their share price chart over the 5 and 10 years, right? Or even longer. Some might go back to 2007 share price data, right? If you happen to see any share price that moves like a roller coaster, normally that tells you something about the company. If it's very long ago and there's a change of ownership, then probably, let bygones be bygones. But if not, then try to look into that period, what happens to the company, crash up and crash down. I'm sure Bursa or the regulator has already watching on the company itself, right? Let me give you an example of how a good UMA, we talk about UMA, everyone has a bad impression of UMA. Oh, UMA is a goring case, but some of the cases, they have UMA, it's not exactly goring, but maybe they could do better in terms of corporate governance, in terms of transparency to shareholders. Let me give you an example. Back in COVID-19 times, which is 2020 and 2021, I think a lot of people might recognize this company. There's a certain company that are involved in doing design and building production lines. Okay, in somewhat sense, we can call this company a semiconductor company. But if you look at the financials of this company, their performance is somewhere in borderline profitable and also losses for an extended period of time. Normally, under normal investor circumstances, you will not look at the company. But during that time, number one is we got a lot of excess liquidity. We got EPF withdrawal account. We also got investors that have nowhere to spend their money but to put into the capital market, right? So the share price of the company actually start to move from 1 to 2 ringgit to 10, and ultimately I think 50. It's not the company in this chart. I did not show that company, but I think it moved close to 50 and then share split happened, right? That is due to them securing, I think it's close to securing a contract from a major EV car maker, company T. I think this announcement itself or this information, it could change the company forever. It is different company at all, right? Now, there's UMA being issued to this company, I believe, and this is considered very substantial news by right. But if they haven't secured a contract, they have no requirement for them for disclosure. Of course, the management, upon the UMA actually carries around queries from the exchange to ask, hey, what is going on with your company, right? I think they could have done better in terms of disclosure. Number one is to update the stakeholders what is going on with the company, and also to be fair to the minority investors as well. Although anywhere in between, there are analyst report that comes out saying that, oh, they're close to securing a contract, etc., etc. But I think coming from the company itself would be more convincing, as not everyone have access to that research report, right? Back to this company. they had issued them a UMA asking them to disclose more about that particular contract that they are about to get. But I think probably they signed an NDA, which is non-disclosure agreement with the counterparty. I think it is in effect even until now. So they did not disclose anything, right? So this is a somewhat positive example where the company really have something going on that is positive, but they will issue an UMA. But the rest of the session today, when we talk about UMA, most of them normally they are not so good examples, right? So why is UMA important? So imagine that if you buy into the company that I mentioned just now, 130, 140, 30 ringgit, 40 ringgit per share at the time, and you do not know what is going on in the company and you hold on to it, I think you might or might not, you suffer some losses, right? At least it's not as bad as this company over here that crashed down. But as a minority investors, the more transparency of the company that give disclosure through UMA, the better that we can assess the company, whether should I hold on to it, should I do any action on it, it is better that way, right? So as we discussed earlier, again, the keyword for tonight is that good corporate governance should take care of the interests of everyone, including us, which is the minority shareholder. And that for taking care of the interests of everyone, there needs to be a balance of transparency and both. You need to be transparency and do not violate NDAs, of course. So there's a hard line to be balanced. Okay, so where I think for a lot of public listed company, when we go and assess, I think it's very important for us to check, does the company come out and clarify whether there's any rumors, whether it's intended or non-intended, that is existing in the market, that trigger the significant share price movement and ultimately trigger UMA, which is not so good for the impression for the company. Again, when you look into any company, first, when you see a substantial move in share price, first thing of the interest, who will be benefited from this movement, right? Imagine someone with significant control over the supply of the shares. We talk about supply and demand in the interest of corporate governance as well, and also interest, okay? So the person who is the most benefited also hold most of the shares of the company, right, on a normal basis, because they have the highest interest in this event, right? But at the same time, if you look at it, how does the market works? Actually, the capital market is a supply and demand kind of game. Every day, the price movement of any company is actually stemmed from supply and demand. So who holds the most demand? Most supply of any public listed company? The substantial shareholder or the major shareholder, right? So any movement in price, a lot of times, we need to look back who is the substantial shareholder. Does he or her have a track record of doing something funny, right? And then, would it be best if you can profit from this kind of way? I can say that it's not very consistent. And when it comes to rumors, how do we handle it? We talk about the rumor in coming slide, okay? Okay. So this is where when the company, sorry, I should move to this slide earlier, but whenever a company triggers the UMA, right, normally Bursa will have a requirement for them to update on their corporate governance, corporate development, anything significant that the company has ongoing, like the one I mentioned just now, which they secure a major contract or they are going to venture into something new. For example, like recently, if you guys see, there's an ICT company that suddenly moved, I think more than double in share price, that a lot of rumors saying that, oh, this company is going to AI, whatnot. But has the company done the disclosure? I think not yet, right? And then any interesting rumors, whether intended or non-intended, coming from who, a lot of questions being asked, right? So does the company come out and then they try to clarify the rumors? Some of the companies I see in Malaysia, the larger scale company, whenever there's a rumor, they will come out and say, hey, this report or this news itself is not true. We have not ventured into this, and then we will do an announcement in due course whenever something concrete happens. I think that is some good initiative for them to keep investors updated, to keep the transparency ongoing, right? And then on the third part, the left corner, I think we need to go slightly technical, as this is a serious topic, as I mentioned just now. Corporate governance. So under the paragraph 9.03 of listing requirement, a company actually, it is by law, they need to disclose any material information. Material information is actually quite subjective to each and every company and their threshold for announcement, right? Material information might include information that impacts their asset and liability, their business, financial condition, prospects, and also dealing with employees. So why is dealing with employees also important? And if you look back into, again, in 2021 and 2022, there's a case of, I think, poor social governance and also poor internal guidelines that have illegal foreign workers and also bad treatment towards foreign worker, led to a destruction of value in a certain electronic manufacturing service company listed on Bursa Malaysia. I think a lot of investors see this company lost 90% in terms of the value in this company just because they do not follow exactly a good social governance and so good corporate governance in terms of disclosure, right? So be very careful on the companies you are investing into. And also 9.03, when they deal with a supplier, customer, and other parties, so they would need to make an announcement as and when there's something material. So material is something, in layman term, is something significant to the company. Okay, and under the same ruling, paragraph 9.03, anything that might cause a dilution to the rights or the interest to the listed issuer securities, and it may affect the size of public shareholdings of the securities. That means that when you hold 100 shares, initially you own the company of 0.01%, for example, right? And after that, after this incident, let's say they do a private placement, they do a right issue, so they will dilute your shareholding. Effectively, your shareholding in the company becomes lower. Okay, so in this event, it might impact your right as a shareholder. So all these announcements, they would need to be made. Okay, and I'm going to touch a bit about the case in January 2024 over here, because I think this is a very important topic in terms of the interest to the minority shareholder, and also a topic of UBO. Okay, so I think back in January 2024, there's a substantial case where you see a chain of companies, I don't want to name them, but you know who, a chain of companies all see the same in drop of share price over the same period, right? And this is an extreme example of where bad corporate governance happens. Okay, I'm not going to talk about their financials and whatnot, that is on another topic, but let's talk about in terms of disclosure, okay, and transparency on ultimate beneficiary owner, UBO. That means that, okay, if I were to use your name to invest in a company, who is the ultimate beneficiary owner? Effectively, it's me. And I need to make proper disclosure to the public that I am actually the UBO. This is actually my proxy or nominee, right? And as I mentioned just now, we talk about the supply and demand. A lot of times in capital market, it's very hard to control the demand, unless otherwise you do it external forces, quote unquote, or you have some ways to get the public or who to get interested in your company. That's one of the way to push for the demand. And another way, a simpler way, if we work it around, is to control the supply, right? But if you look at the ruling of Bursa Malaysia, okay, any public company in Malaysia, you need to have a public spread of 25%. That means that at all times, 25% shareholdings of a company must be held by external parties. That means that it's not under the same party that holds more than 75%. That includes person acting in concert, PSC. Okay, so imagine if a party holds 90% of a share, what happens to the liquidity? It will become illiquid, and manipulation could happen easier. Of course, there are some rare cases like Mr. DIY. I can name them because this is something that they publish. They have the exemption to adjust the public spread, I think, to 15%, because during their IPO, their size is very significant, right? This is a genuine case that they able to, apply for exemption on the public spread. But on normal basis, for let's say a company have 1,000 shares, 250 of them must be at the market at all times, right? A healthy public spread, it means that like 25%, 30%, or 40%. This is what we consider a healthy public spread, and maybe even up to 50%. Means that this company is having a balanced and normalized supply and demand in the market, right? And then we all on day in and day out basis, we see seller and we see buyer, then move on. Expectation of the value of the company. Some people expect the company become better organically, the share price move up. A lot of people think that the company will not perform well in the future. Organically, the share price will move down. But what if the substantial shareholder, the 75% party, or maybe the 50% party, they have some proxies in whatever way to hold the securities, which go and impact the supply of the market. And then this would cause an inflated demand through the way of reducing the supply significantly, right? They get someone to hold the securities, resulting in a reduction in liquidity and also the supply. So this will result in a more drastic kind of move down or move up in terms of the share price. So by good practice of corporate governance, I think a company should at all time disclose their UBO. Who is actually the UBO? I think this is a hard-on requirement, and they should at all times should not violate the public spread. Okay, so how should you avoid this, or how should you be careful with this? Try to look into annual report of companies. If you see the top 30 holding anywhere around 85 to 90%, I think you might need to be a little bit careful with the company, because a lot of shares are being tightly held. So that's the case where you need to be really careful on that, right? And in January 2024, there are a lot of complex cross-holding that causes that, hey, your share price is being dumped, okay? So me as a UBO, I control a lot of supply, so I can dump the shares. And if there's a cross-holding means that I hold your company and you hold my company. So when I see your share price crash, so naturally I will dump as well. But at the time you dump my shares, I also dump your shares. So a lot of very complex web of cross-holding of securities, I think that's ongoing during that time, and resulted in massive destruction in value for shareholders as minority shareholders. And so how do you identify this kind of scenario? One is from annual report, see how tightly held the shares are. And another way, more simpler way, to look for any company that have a perpetual upward in share price, right? So I'll give you an example. 1 week, we have 5 trading days. So out of the 5 trading days, always 4 trading days, they are in the green candlestick. That means that the company is always slowly going up, no matter the market is good or the market is bad. And then every day there's a significant liquidity on the company. Okay, liquidity is a bit technical. I think it's very subjective whether it's genuine liquidity or non-genuine liquidity. But regardless, one of the ways to look at this kind of companies is to look for companies with quote-unquote perpetual upward in price. No company can always move up in price perpetually, right? Just as the value. When you're doing business, there are ups and downs, and naturally in share price, there are also ups and downs. So if you see any company that share price going up non-stop, be very, very careful on it, right? So next topic, we're going to dive a bit deeper into the information you receive, because we talked about supply just now, what happens to the supply, and the way to create demand, one of it is to spread rumors or information, right? Intentional or unintentional. So you see, information is a very interesting thing. We get access to information very easily now. At a click of a phone, we can access a lot of forums. We can access our WhatsApp, sometimes our friends, family, and whoever, whatnot. They can send you a lot of information about a particular company, right? So in a way, information can create interest, and interest can lead to conversion of buying power effectively, and hence the movement of a share price. So, and fully understand that in the capital market, we always hear different kind of rumors, but when we hear any rumors, how do we protect ourselves from it? Should we listen to it? Should we not listen to it? I'm not saying that the people who give you the information have ill intention, because sometimes they are family member, but try to think, where does this information come from? Where does for example, my uncle trying to give me a tip on a particular stock, but where do you hear from it? Okay. And then trying to think more logically, like some of the things here you see, there's a mention of possible contract win. There's a new substantial shareholder coming in. Next quarter going to be good. They're going to acquire a very good company. There's a potential reverse takeover. And of course, the hot topic now is that anything related to data center, basically, there will be a lot of interest flock over there, right? And I think with all this overload and overflow of information, the first thing everyone should do is to try to assess, is this realistic? I give you an example. For example, a construction company, and they tell you suddenly they got a subcontract from NVIDIA to manufacture GPU. Do you think this is realistic? Certainly not, right? It doesn't even make sense for a construction company to venture into complex semiconductor. So when it comes to news or rumors, try to validate the credibility of the existing business against whatever that is new coming into the company, and then try to think, does the execution plan make sense? The timeline, whether it makes sense or not. Do they have sufficient manpower to handle a new project or unrealistic project size? Let's say the company has been doing, let's say 100 or 200 million in revenue. Suddenly they got $1 billion size contract. Sometimes it's genuine, and you need to assess whether they have the capability to do so. If not, are they getting more manpower, or what kind of things are they doing to handle the project? Are they raising more fund? Do they have sufficient capital to handle the new project? And then is there any new talent coming in, significant movement to the management? And when the company is trying to venture into a new business, sometimes there are public information that you can access. Going to Glassdoor, going to LinkedIn, going to JobStreet, see whether there's any job opening for that particular position. Normally, there will be signs that, okay, if a company really is venturing into data center, you will see that they are hiring some more talents over, right? If not, how are they going to proceed with the project, right? So a lot of things that we can actually go and think about whether this is realistic, whether this is something that can be done or not, right? And I think this is something someone told me back in 2019 and 2020. There is a particular oil and gas company that get billions of contract value, and the share price moved very significantly. A lot of analysts, a lot of fund manager actually buys into the company because they trust the person over there. But on hindsight basis, of course, on hindsight, the manpower size of that company actually remains constant for a very long time, according to channel checks. Hindsight again. So if you happen to hear something about a company, right, that the company reveal, again, back to UMA, they do not do any disclosure or whatnot, try to do some channel check with your friends in the same industry, see whether this makes sense or not. So I think this is one of the way that you can avoid trouble during investing in a company with the rumors and whatnot, right? And yeah, so as you can see here, the price is moving very, very significantly. Again, I don't want to name the company over here. And one of the things that I always like to ask myself is that, am I really the first one to hear the information? And who am I trading against? Who am I investing against? Can I really leverage on this information or not? So these are some of the things that you need to avoid to, imagine if you buy at a peak here and then the share price crash afterwards, so that you will suffer significant losses in your portfolio, which I would say unnecessary losses if you do your qualitative study properly, right? And then we briefly touched on management just now, and now we're going to go a bit deeper into management part for the corporate governance. Okay, so for me as an investor, when I look at any public listed company, I would think that the management of a company is critical. Imagine that if you have a fantastic business, but the management is dishonest, what will happen to the business? And frankly, as a minority investors, we really have a limit to how much information that we can access. Okay, so when you look into business, really need to look into the management of the company. Who is managing that company? And the question mark here is, how do we assess or how do we conduct studies on existing or some new management is coming in, how do we conduct the study? I think the first very simple way that you can do is go and research their name. For example, who and whatnot move into this company. Trying to look on Google, is there any misdoing of them over the past, and trying to assess the information. Okay, if they were done, I'm not trying to point any fingers, but if they done and something that is dishonest in the past, so your trust level should also be reduced, because there might be repetitive kind of situation coming up again. So be very careful. Or alternatively, if you were starting a company and you see this individual which have a dishonest or funny kind of history as the shareholder in the shareholder list, this is something you also need to be careful, right? And I think this is one of the very important part to try and assess whether the management have done anything funny before, or what are their background. I think during COVID times, there is a particular company that wanted to venture into glove, and they actually got a very interesting name that is from a very interesting background that normally if you see, you wouldn't invest in a company. But of course, that's during the glove mania, right? So everyone just rushed in, and ultimately the share price crashed. Okay, so trying to look into the management of the company and then the project they are taking, is this all really making sense together that I can invest in this company, right? And so the reason we need to do this manually is because disclosure, ultimately they're coming from the management and also board of directors from the company itself. So if they were to trying to play games, and avoid disclosing something, again, as a minority investor, there's a limitation on how much information that we can access. So try to identify and look at the track record and also past performance of the company, and try to assess this management. Is it trustworthy, right? And in Malaysia, I think there are this is another case that where the company is not performing, but the director or the board of director or the management team is drawing more and more salary away. Again, we're going back to the term interest, right? When a company is not performing, but you're drawing more capital away from the company, what does that mean? It means that you're killing the growth of that company, and you're being irresponsible because company is already not performing. Why are you taking out more money, right? So this can be seen in the annual report, the remuneration, and so board of director fees. But if they are truly able to drive the company's growth, they are taking more of that salary or bonus or whatnot, I think that's reasonable. Again, this is on the basis that it's not violating the fine line of corporate governance, and also fair interest between the management team and also minority shareholders. So balancing is really art over here, right? And I think for those who are in the market that is long enough, you may remember this company, or if you are new to the market, probably you do not know about this company. This is a case back in 2006 and 2007. The reason I'm able to talk about it is because this is something already factual that has been published. So talking about Transmile, right? This is a case study for you to look into to prevent falling into the same trap over and over and over again, right? This is quite similar to the oil and gas company that we mentioned just now. Transmile, looking back at their history, they only took 4 years from founding to listing in 1997, if I'm not mistaken. Following their listing, for the next 7 years, for a certain period of 7 years, net profit CAGR actually grow at a 45% for 7 consecutive years. So imagine that every year compounding basis, your money grow by 45%. How substantial that is, right? And this company, again, they're delivering substantial, very, very good results. Their cash flow, okay, cash flow is a bit tricky. Operating cash flow wise, they are okay, doing decent. And the shareholder profile is also very good. Includes Corp Brothers, and I think Post Malaysia, and some government funds. So with this kind of portfolio, as an investor, retail investor, right, it's very tough to see what is wrong with the company when a company is performing well, they have cash flow, and they also have a very strong shareholder list, right? So at the peak, Transmile, I think their share price actually touched 15 from 1 ringgit or 2 ringgit, they move to 15. And I always tell myself, when things are too good to be true, probably they are too good to be true, to grow at a CAGR of 45%. At the company's peak, the share price touched 15 ringgit and then they crashed back to, I think, less than 10 cents. So what happens in between this period? And long story short, this is an indication that you can look for, you can check on the announcement of the public company. Long story short, this company, their auditor refused to sign off the financial year 2006 account. So when they refuse to sign off, they will need to do an announcement on the delay in terms of coming out with the annual report. So whenever you see any delay, except for COVID period where a lot of companies, they couldn't, auditors or account, they couldn't access the office and also their supplier and whatnot. But on a normal basis, right, if you happen to see any delay in coming out with annual report or coming out with quarterly report, it's normally a very, very bad sign for the company, right? And normally I would immediately run from this state company. Why? When a company have a huge problem, then they couldn't reach a consensus with the auditor, they would need an extension of time to negotiate the term. That's why I think our exchange has been very stringent on this. They are very hard to give. It's very tough for them to give extension of time for coming out with the annual report unless a very good reason is behind that, right? Normally, listed companies, they have 4 months from the closing of an account to publishing the annual report. So if you see any delay in annual report, subsequently you see a resign of auditor, needless to say, confirm there is problem with the account of that company, right? So be careful on that. So for this company, again, 2006, financial year 2006, refused to sign off. Then afterwards, the company formed, they have a special audit has been conducted, and there's a sort major misstatement of the accounts from highly profitable, highly growth, and I think they bought a lot of, I think they bought Boeing, Airbus also. This is a transportation company. From that profile of a company, the share price after discover the misstatement of the accounts, ultimately share price crashed to less than 10 cents. Okay. And so if you look back onto this company itself, right, I think 2 critical things that we can learn from this incident itself. Number 1, during the period of listing to 2006, 2007, the major shareholder actually, they offload a substantial stake into one of it is Koch brothers. And when the founder of the company, they are trying to offload a major or very substantial stake, that happens, substantial stake of their shares, that happens. So you need to be very careful, right? Why is the owner that handles the in and out of a company, if the company is so good, why are you selling, right? There are times that when the share price went up a lot, the owner say, hey, I need to get some money to use also. So they sell a reasonable stake, then I think it's okay, reasonable. It still gives a negative impression to investors. But I think as human, it's normal to take profit, even though you are management of the company, as long as proper disclosure and you're not insider trading, right? But in this case, number 1, major shareholder, they're selling off a substantial stake, which again, we need to look into. Number 2, we mentioned about cash flow just now. A lot of time we look into the operating cash flow of a company, but if you dive deeper, if I'm not mistaken, this company, they have out of the 7 years we mentioned, 5 to 6 years, their free cash flow is actually negative. I don't know how they do it. I'm not an accounting expert, but in between here, they are able to make funny accounting terms that got them profitable on the surface, and also they got cash flow in the operating level, right? And one of the symptoms of this kind of funny companies, right, is that they are constantly raising funds every year. Okay, under the Bursa guideline, actually for any listed company, they are automatically what we call mandated that they can raise, they can issue 10% new shares to do a private placement to raise fund. Every year they get 10%, subjected to the shareholders' approval at the AGM every year, renewal on an automatically basis. So anything beyond 10%, they might need to go and apply. But if you see a company, if they are healthy, if they are growing consistently, why are you constantly raising fund that to support your growth, right? It's something, somewhere is not right. Imagine that okay, I'm a healthy company, I'm getting more cash, and I'm growing. Why do I need constantly fundraising? If you want, then probably over the 5 years, you did it one or twice, not every year constantly fundraising. So you really need to look into this, okay? This is one part, that constant fundraising, be very careful with it. Then subsequently, 2 years ago, I think on Bursa, we have another company that their core business is in selling and also leasing of EDC terminal, where during that period, there's a resignation of CFO. For a CFO to resign without proper reason, I think two CFO resigned in a span of 3 years. And auditor also resigned, if I'm not mistakenly, which when you see any auditor resign over the past of tenure of 5 years, more than two auditor resign, something is wrong with the company for sure. When auditor comes in, normally they will stick with the company as long as the company is doing something genuine, right? When an auditor resign, it means that something is really bad. This is the worst stage possible. That the company, something is wrong with the account. Is the auditor is indirectly telling you, we're resigning, something is not right, we couldn't do the accounts for this company, we are not signing off the annual report, right? And this is a very good indication. And constant selling shares by the top management team, really need to be careful. Why are they selling shares if the company is so good? Always back to the square one, interest. Try to think of different parties' perspective, their interest. If it's so good, why are you selling, etc. Okay, but of course, not all the companies, they are transparent in nature. So disclosure, I think, is something that we need it very much as a minority shareholder, but it's not really so accessible on a lot of information, right? And to recap, so how do we look on the possible board oversight and also some independent parties that are telling us some of the sign? To recap, change of external auditors, some accounting irregularities. So what do I mean by accounting irregularities? So you see that some account, they have constant one-off profit, one-off expenses. Those are what we consider something wrong with the account. If one or twice, I think it's reasonable because, you know, as a new accounting term come in or running a natural course of business, normally when time comes, you may or may not encounter new stuff that you might need to adjust your account for a bit, right? But if it happens on a constant basis, for example, a company profit is constantly supported by other income, so you know that you need to really look into the financials of the company. Why are you constantly having other income as a profit? And then through the announcement that you see from Bursa, if you see some familiar names, feel free to Google them and see whether interesting persona. Try to look at their background. Who are they? Are they qualified to hold a board position or to hold management position in the company? And then assess from there. And then, of course, departure of CFO is another very good indicator that the company, something is wrong. Something is wrong with the corporate governance in that company, that there's a possible misstatement or whatever that is not right that's happening on the company. Okay. And okay, I think this company, I wouldn't name the company. This is a company that they got delisted, I think back in 2021, if I'm not mistaken. They got delisted, company Care. You guys can go and look for it. This company, when you look into their accounts, they have a significant trade receivable. I think it's around 250 million, which is equivalent to their single quarter revenue. And looking into their balance sheet, their cash balance for a listed company that's running around 200 million in revenue for every quarter. Cash balance at the time, I think in Q3 or Q4 report, they only have 2.2 million left in the bank. Imagine that you're running a business of 200 something million. You are only having 2 million in your bank. How do you run a business? And total debts, I think at the time is 140 million. And this is already, without mentioning corporate governance on financial basis, this is already a huge red flag. And then at the point of time, I think there are reports also that, hey, the management suddenly gone missing, which is a bad corporate governance example. You should have declared, but of course, if they have the intention of running away, then how would they declare, right? And whenever a management of a company gone away over the past tenure of, let's say, 10, 20 years, so far nothing really good has happened to the company whenever a management suddenly missing, which to me is a mega red flag, right? And for this company, again, if I'm not mistaken, there are several transactions that are not on arm's length basis. Basically, it's on fair and transparent basis, which is the core of corporate governance. Okay, when you assess any company, you see a lot of terms called RPT, related party transaction. If there is a high frequency of doing RPT, be very careful. On a listed core basis, listed company basis, you should have a very good distance between your own personal interest and also a public company interest, right? For disclosure of related party transaction, for example, if I own a private company that is, let's say if I'm doing plastic manufacturing, right? I'm having a company that is doing downstream that I'm supplying to them, right? So for example, they do plastic packaging and I'm doing plastic pellets. When I'm selling my products to my own company, how do I ensure it is the best pricing? So when I see a lot of RPT, I will be very careful. Related party transaction, again, be very careful on that. As again, when it touches the interest between management, the company, and the shareholder, be very careful on that. I think this is a very hard point for any individual or any company to balance perfectly. Okay, and as a result, back to this company, I think the share price also crashed, 90+% loss in terms of value, and the company subsequently got delisted. So some of the pointers here that you can take that, number one, look at their balance sheet and look whether they are fundraising. And secondly, also look on the trade receivables, because a lot of times trade receivable is a result of them stacking a lot of bad things together until this point of time, right? Revenue, one-off, you can do creative accounting on that. But to put away the profit that people fabricated, they would eventually need to put somewhere, which is trade receivable. So under accounting term, trade receivable, they have a tenor to impair them if they are not able to collect back. If you see a constant impairment of trade receivable or doubtful debt, except banks that is their core business. So apart from banks business, if you see any normal business, they have constant impairment of trade receivable or impairment in terms of bad debts. So you know that something is not right with the management. Either they are not managing the company properly, or in some way they are putting out the money outside there, but they are not able to collect back. So there is definitely something sketchy going on if there's a constant scenario of such going on. Right. And then corporate exercise and financials. I think we touched quite a bit on financials just now, so I'm going to focus on corporate governance. I had mentioned just now, the paragraph 9.03 has mentioned one of the things is the dilution in terms of the shareholder stake. Okay, so what does dilution mean for those who are new? Basically, in the same pie of cake, now we got more slices, right? So you need to dilute your share to include more shareholders, or your portion of the cake becomes smaller. Okay, so what kind of exercise is there to dilute your shareholders, right? For example, number one is that private placement. Again, constant private placement doesn't only shows the company is constant in need of a lot of cash because you're constantly raising funds. It also shows that the company is constantly diluting your shareholder rights. And then secondly, the right issue. On a normal basis, company normally they do not need to do right issue. Okay, cost of equity is always more expensive than cost of financing. If they're able to raise fund to complete something, I think it's better that they could raise fund to utilize it on a reasonable gearing level. But if they're doing right issue, and if you look back to the history of the company, if there is incident of more than 2 times right issue over the past 10 years, be very careful. Even more so, if you see any share consolidation, you also need to be careful. Okay, and if you see any company after they done a right issue and they have free warrants, I know free warrants is something that very attractive for existing shareholders, but please bear in mind that warrants are also dilutive of your shareholding. For example, new investors, they go to the market, they buy warrant, they convert. The total number of shares or in the same cake, there are more slices now because more investors is inside. Your shareholder right, your EPS, your earnings per share, your dividend per share, net tangible asset per share, all they got diluted, right? So on a good corporate governance basis, normally they won't go to constantly raise fund and as such, right? So any exercise that could possibly dilute shareholders, right, they must be closely monitored. This is one of the way that you can avoid those what we call red flag companies on Bursa. Okay, and then if in the event you are new to the capital market, I think this is just a recap on what are things that you should not really go and monitor. You should not really put your money in unless you done your homework on a very rigorous basis. Other than that, these are the indicators that you should normally stay away. They are there for a reason for you to, don't touch on this topic. Number one, PN17 and also GN3. PN17 and GN3, normally these companies are in financial distress, whether their shareholder equity is too low, or they are in negative shareholder equity, or the company has going concern. Going concern means that the auditors suspect that this company, they might not be able to sustain their operation, right? So let me tell you a bit more about PN17 and GN3. Let's talk about PN17 first. Whenever a company fall into PN17, whether investor like it or not, institutional investors under no, that means fund manager, under no circumstances, they need to sell, they need to dispose, right? When they dispose, whether they like it or not, the share price will crash. There goes your loss in terms of value, even though the company might be able to rebound in the coming quarter, right? So same goes for GN3. GN3 is just another PN17 term for the ACE market. So when you see this kind of companies, normally I would stay away unless you really concrete that the regularization plan of the company is so solid that you're sure they are going to come out from the PN17 or GN3 status. And just now we mentioned about fund must sell, and now if they move out, the prospect is good, fund needs to go in, right? And subsequently, no cash flow. Again, good corporate governance, normally they wouldn't have a cash flow issue. And again, high debt level. When you properly manage a company, I don't think you would have too high of a debt level, unless otherwise you are very capex or asset intensive company. And when something makes no sense come to your ears, and then the company, they are not doing any clarification, and then there's an upward in share price. So you will know that again, someone interest is already in the market. So when you're buying into it, are you sure that your interest is being taken care of, right? Under this scenario. So really try to assess all these factors before you look into any companies. Okay, I think we just 1 minute left for the presentation session, but I think quite a bit of companies that are coming in. Okay, I think we can move into the Q&A session now. Over to you, Shane.
Thanks so much, Max, for sharing with us how do we identify red flags through corporate governance. So if you have any questions to ask our speaker today, you may write them at the Q&A box here, not the chat box, write them at the Q&A box. So the first question I see on my screen is, so just like I mentioned about high debt level. So on what kind of threshold do you consider the company having excessive debt?
Okay, normally on a gearing of 2 times, I would be careful with the company, even it's a asset heavy company. But I think some of us would argue here, hey, you look at YTL so highly geared, right? Then their share price is still performing. So this is one of the extreme cases. The rationale behind high gearing level, you need to be careful, is because when they have high gearing level, once a small mistake on their business and they couldn't repay the debt, they will also fall into PN17. If there is a default of repayment to the bank, whenever the bank issue this one, that there's a default in payment, they would also go into PN17. Again, whether the company can turn around or not during that period, some of the holders of that company, they must first dispose of the share. So there is a risk underlying risk when there's a high gearing level for the company. So normally 2 times and beyond, I'll be a bit careful on that.
Thank you so much, Max. So 2 times, yeah, gearing ratio. The next question is, can you delve deeper into specific areas within the financial statements, such as off-balance sheet liabilities or unusual non-cash accounting items that might raise concerns about corporate governance?
I think if you could give me examples of what kind of off-balance sheet liabilities or unusual non-cash accounting items, that will be better for me to answer you. But I think last time we have for someone mentioned AirAsia, right? At a point of time, I know of course AirAsia now has successfully turned around, but back in then, before they fall into PN17, there comes a particular MFIS, I think it's MFIS 16, the categorization of lease liability, which means that this is, if I'm not mistaken, last time they leased the what we call the planes. Last time is actually an off-balance sheet item, right? After they put into that lease liability and also right of use asset, there needs to be depreciation and whatnot, so that significantly impacts how they show on their cash flow statement, balance sheet, and also their profit and loss statement. So that is one of the example over there. And some of the things that might raise corporate governance is that high trade receivable, whether it is current or non-current trade receivable, and then you try to link high trade receivable and also related party transaction. Some of the companies, maybe their RPT is small, maybe a few millions at a time, but they are stacking up their trade receivable. We do not know that whether this trade receivable is being, there's a RPT done, and then they put it under trade receivable, and they do not know whether this money is able to be recovered or not able to recover. Okay, so this is one of the things that you need to be careful on that. When you see a increasing trade receivable and also the significant constant RPT.
All right, thanks, Max, for sharing your perspective. The next question is, could you provide a framework for evaluating mergers and acquisitions, whether such exercise are value accretive for shareholders considering potential governance risk?
Okay. Okay. So sorry, I think I a bit miss out on the potential M&A. So when we talk about M&A, I give you another case. When looking into any potential M&A, especially the A part, we should really go and assess whether the A part, the acquisition, whether it makes sense or not, right? Because you're buying into the listed company, your interest ties with the public listed company. But when they're doing acquisition, they are buying an external company that we do not know the background of the external parties, whether they are financials. We are not doing the due diligence part. So when they are buying any company, that could cause a dilution in share price, whether through they raising fund in order to buy the company, or they are issuing part shares and part cash in order to acquire the company, or they are completely issuing new shares to buy the company. So you need to see whether there is any potential conflict of interest. One of the way that is a bit extensive and also not easy to be done for minority investor is that you can try to dive deeper to understand more about the company. If you could, you can buy the SSM report of that company. See, normally they will give you a profit guarantee for new company. See whether the profit guarantee makes sense. For example, like last time, this company, they are not having they are not profitable. Let's say for the past 3 to 5 years. Past 3 years is not profitable. Suddenly it spike up, and then this is the timing where the listed company is buying into them. I think that is a bit suspicious, and also questions about the sustainability of the company continuing serving the profit guarantee going afterwards. Okay, not only the company first use their cash pile, which is important for any company, or they are already diluted shareholders to buy something new to put into the company. I think there's a risk where you need to look into the background of the company. Normally, I will also look at the surname of the buyer and also the seller of the management of the company, see whether there's any similarity in terms of surname. to see any potential, unforeseen interest in between during the M&A exercise.
Thanks so much, Max. The next question is, where can investor find reliable sources of information about company corporate governance practices?
Okay, I think every year in the annual report, you can see that they have annual report and also they have a corporate governance report. This company, whenever they issue the corporate governance report, remember this is something that the public listed company wants you to see, right? This is something that they have done, they have compiled for you to see. I think if you really want to access the corporate governance of that company, you have to dig deeper. For example, you need to looking into shareholder list, you need to see who are the shareholders and then trying to find out the background of the shareholder. Sometimes you see something over there, or you can look into a lot of website, especially SC website, trying to look into whether there's any public reprimand being done. Normally after public reprimand, they couldn't stay on to the company anymore as a director, but they can still hold the shares. But normally any smart people, they would just go through proxy to hold the shares. But I think a very basic search, and you just put any company name and trying to put a scandal or misstatement or any corporate governance issue behind the name, you just try and Google that. I think it's very easy to access online, because nowadays anything that has already happened, there will be public reprimand being done, or there is a investigation case being ongoing for that part. Okay. I think in terms of the information we have already gone through, annual report is one of them. And also, let me think, a reliable source also is the, if you can access, you can try to go for CTOS. Normally they will have a list of report whether this person has got any public reprimand, not only by SC, but also external parties. So I think annual report is one of them. Any corporate governance practices, I think UMA is one of the good indicator. And Bursa announcement, I think a lot of things can be told there through UMA, departure of CFO, and then resignation of auditor. And in the annual report, try to be a bit more hardworking. You need to search a lot of names over there.
Okay, thanks, Max. Having mentioned about our UMA, Kiao Chan asks, I'm using Rakuten Trade. So where do I find details about this UMA in the platform?
Okay, I think you can go to Bursa website. It's free, regardless of what platform that is using. Okay, so let's say if you you're using Rakuten Trade, you can always try to Google Bursa announcement, and then under the Bursa announcement, you can just key in the company you are looking into, or alternatively, I think you can filter the announcement, see what company they got issue UMA, or if you have the daytime, you can try to look over the news. I'm sure you guys have KYC screener installed on your phone. So you can look. Normally the news they will publish as and when any company they got UMA, there will be news published as well. So reliable source will be Bursa website, where you go and filter and check whether there's any new UMA coming out. Secondly, you can look at the news sources. I think whenever there's a new UMA come out, a lot of news channel, they are eager to publish and talk about it.
I think recently I read the ruling that Bursa Malaysia will implement a new practice that aside from issuing the UMA notice, they will also issue a warning to these companies, to the retail investor about these companies having this kind of unusual market activities. Yeah.
Yep. They will issue through the broker website. I'm not sure about Rakuten. I don't really use Rakuten, but I think all brokers should have the function to, pop up, hey, we issue a UMA and we think that the share price movement is unusual. So you should really need to look into that.
So the next question is by Steve. So why do institutions such as EPF, where they buy huge volume of shares today, then a few weeks later, they also sell them? The same goes for company directors.
Okay,
What would be the
I
reasons?
think Yeah, I think a bit different between EPF and also company directors. Let's talk about the transparency and also insider trading, which is a critical part in terms of the corporate governance. Okay, so when we talk about EPF buying and selling shares, EPF actually they have a couple of departments. So apart from being a what we call a fund, they also have a trading arm. So sometimes a fund they would buy the shares of a company and their trading arm would sell, but they would also be announced under the name EPF as well. So you see constant buying and selling. It's not exactly insider trading. But when it comes to the director, where the director normally have one single account, so you need to try to assess whether the director, whether they have how many shares are they holding? Are they the substantial shareholder? Again, if they're the director, number one, they know a lot about the company. They know the ins and out about the company. And number two, if they are substantial shareholder and they're selling, so something is definitely not right, especially when they're selling on open market. Only under very bad scenario that they would choose to sell on open market if they were telling you, oh, actually there's an institutional investor that is interested in buying into my company, but the market float or the market liquidity is not sufficient to support the volume, then sometimes they have to cross their shares through off-market transaction. Then this is considered a more normalized transaction where they actually institutional investors is interested in a company, which is a good sign. And if the company director is selling, share price is also dropping prior to result season or annual report season. So I would be really careful with what is going on with the company.
Yep. Thanks, Max, for sharing your perspective. You mentioned about trade receivables many times. So the next question by Ang is that how do you look at trade receivable alone, or use days to receivable to measure? If there's no change in days in receivables, do that raise any concern?
Yep. Definitely, we need to also look at the days to receivable. Imagine that last year your day to receivables is around 50, 60. Now suddenly become 70, 80, and suddenly become 180. So there's definitely, apart from corporate governance, business-wise, there's something wrong going on for the company, because your trade receivable or your period of taking back the cash is getting longer and longer and longer. And cash, they actually carries a value, right? If you are depleting your cash for a lot of times, so you are burning your own resources. Okay, so imagine if the trade receivable is getting longer and longer, I would be very careful on that, because one, it hits a certain threshold. Let's say whatever the auditor or the company agrees on, let's say more than 180 days, there could be in a watch list, doubtful debt. Subsequently, doubtful debt after another 180 days, if they're not able to recoup, then it will become an impairment into the account. As I mentioned just now, trying to work out the trade receivables and then see whether there's any disclosure on the related party transaction, then you will find out something sketchy or not is going on in the company. Otherwise, if you talk about just trade receivables alone, try to gauge whether the revenue increase and the quantum of trade receivable increase, whether it makes sense or not, right? Because on some companies, like the one we mentioned, the oil and gas company, and the one Transmile, their trade receivables is also increasing very significantly at the time. And another thing that you can link together with trade receivable is their fundraising frequency. If the trade receivable is increasing, fundamental is increasing, but their fundraising frequency is also very high. So you probably need to look into that as well.
Yeah, the follow-up question from him is, what if the days to receivable remain unchanged, but the amount in receivables increases?
I think that is okay, but it depends on the quantum of whether the trade receivable increase is in line with the profit increased by the company, or let's say if the profit or revenue increased by 50%, then your trade receivable increased by 20%. I think still okay, reasonable kind of explanation. But if your profit increased by 10%, your trade receivable suddenly pop double up or whatever, increased by 30-40%, that is something that you really need to look into it, because trade receivable is stacking every quarter after quarter. In normal term of business, the lesser trade receivable, the lower the risk you have in terms of collection. Because imagine collecting debt, even your friend owe you, for you to collect back the debt from your friend is also an effort, and it takes resources, even more so for listed company.
All right. The next question is, there are times where there are fights among the board of directors. So how do you perceive this kind of companies? Should we avoid them?
Yeah, definitely. I can give you an example that one company, I think back in, again, also 2021, 2022, there's a board tussle. Actually, two companies. One is the one that we mentioned just now, the Edisa Terminal Company. The founding members, they are going parting ways. Then they are fighting over board. I'm trying to kick you, you're trying to kick me. So looking into corporate governance side, yes, they do the disclosure, but this is something very bad. Imagine that if you are buying into a company, the board of directors is constantly thinking about how can I kick you out of the board of director so you have no power to coming back into this company, right? There's this incident where the founder of the company is actually being locked out from their own building, that they couldn't go in and access the company. So how would this impact the cost of the business? Definitely bad. Definitely I would stay away from it without a doubt. So board tussle is not something that can be resolved immediately, because over the tenure of a board tussle, it includes AGM, EGM, calling for EGM to vote against, or to kick some board of director and then putting in new board of director inside. So there will be movement in terms of the shareholding for that company, and whether there's any proper disclosure of UBO, we mentioned just now, for the shareholding for the party that wanted to kick the existing board of director members, is something that you really need to be careful on it. So yeah, I'll be really careful on that.
All right. The next question is by Wan Kok. So, what if the directors offer the company shares at 50% below the quoted market price? What is your view on such offers?
Okay, let's say if they are offering 50% below the actual market price, I presume you're talking about DBT, direct business transaction, which is where we see they transact not on open market active buying and selling, but they're actually trading off market 50% below the actual market value. So let's think about this rationally, as we mentioned just now. Think about, is it too good to be happen? Number one, if the company is so good, why are they selling 50% below quoted market price? Right? Unless there are zero liquidity at all for the company. So why are they selling at this market price? Number two, who is the beneficial party for taking in these shares? So what have they done that they deserve a 50% discount? Number three, on corporate governance, shouldn't they offer the same opportunity to all the minority investors to buy at a 50% discount? Assuming if I buy at RM1 now, you're offering someone else 50 cents, how would I feel? Is this a proper governance that listed corp should have? I don't think so. But if yes, the director is selling, if you're willing to sell at 50% below market price, shouldn't you offer to the minority investor to ensure fairness? That's my view on this.
Thanks so much, Max. So the next question is by Mohammad Rusdi. So between cash flow and net profit in the financial statements, which one do you think is more important for us to look at?
I think both is actually important. Okay, profit is an indicative of a company that is actually they are constantly making profit, as the name suggests. But cash flow is a bloodline of a company running. So is there instances where the company is making losses but they have cash flow? Yes, asset heavy companies, because they have invested into the asset, but in accounting terms, there are constantly a lot of depreciation ongoing. So it will impact the profit and loss for that company. An example would be Prolintas. Prolintas owns highway asset. Is there something genuine? Of course, you can see the highway, you can use the highway every day, right? So it's something genuine, but they're making minimal profit and they're constantly paying out dividend. If you look into their cash flow, they're actually generating quite good cash flow. So it depends on really the company you're looking into, but I think both are equally important. If I were to pick one out of the two, I would say that cash flow is probably a bit more important as the profit, as I mentioned just now. There are a lot of ways that you could, to increase the profit on paper. One of it is other income. Another one is through RPT. Probably you can take away some expenses so that the profit number of the company looks better. Or you could reduce the profit of that company by putting some profit out of the company. There are a lot of ways that people can do that.
All right, thanks, Max. I've seen a lot of questions asking about your view on Capital A. As their PN17 status deadline is approaching and there are a lot of news going around currently. So is this considered a good governance to exit the PN17?
I don't know how should I put it on whether this is a good governance to exit PN17, but certainly on disclosure. Okay, let's talk about disclosure part, right? I think they did a fairly good job in terms of disclosure. They have proper disclosure on what is actually going on for the company, on what stage now, what kind of regularization plan that we are doing. And I don't see a lot of insider or director buying and selling significantly. And their business definitely genuine. Me and you, regardless of you like Asia or you don't like Asia, we do use it quite often. So if you talk about governance alone, we are going to only comment on governance. Governance wise, I think it's okay. They're doing their best. Transparency, I think they also do a monthly or quarterly update in terms of footfall and also their fleet, whether the utilization rate of their fleet on monthly basis, if I'm not mistaken. So you have a very good access to their information through their website. It's not only applicable to analysts and fund manager, unlike a lot of companies. So you can already assess the information of the company. Transparency wise, conflict of interest wise, I think the company did quite well in terms of governance alone. Whether or not they are able to move out of PN17, I think if they are not able to make it in time, they can always do an extension of time EOT for them to have more time to go through the PN17. So imagine if they were to start in the PN17. I did not follow the company too closely, but imagine if they were to start in the company PN17, subsequently they might get suspended or whatnot. There will be substantial loss in terms of a lot of investors kind of interest and also not to mention institutional investor kind of interest. So I don't think the parties would be happy to see the company go into PN17.
All right, thanks, Max. So what would be the implication if a loss-making company continue to pay dividends? So how do you see that? So this question is by Chi Seng.
Okay, interesting. I think loss-making company we mentioned just now is that this company, as long as they're not borrowing money to pay dividend, I think it's okay. As you mentioned just now, some companies, because they are asset heavy, so a lot of depreciation needs to be done on their profit and loss statement. And depreciation on accounting terms is a cost, right? So it will reduce your profit level. And in some instances, if the profit of that company in a particular quarter is not so good, that after the depreciation went to losses and resulted in a company loss and paying dividend. So you have to think that paying dividend is actually normally a good sign, right? And any publicly listed company, major shareholder, they own, if we following the guideline closely, on a normal basis, they can only own 75% of the company. So whenever they pay out dividend, the profit earned, they are only getting 75% of the profit from the company based on their shareholding, right? Because they brought from IPO from 100% holding to 75% holding. They are also giving out the rest of 25% of the profit to minority shareholders. So paying out dividend normally to me is a good sign for the company. Number one, you have cash flow, you have the ability to pay dividend, and number two, you are apart from paying yourself dividend, you're also taking care of the minority shareholders by giving them another venue to profit from it, apart from buying and selling your shares. So try to figure out the reason for the loss. If it's something on paper, like we mentioned just now, Prolintas, they have a highway, a lot of depreciation going on, but they have a very strong cash flow to support them to continuously pay dividend. I would say that's an okay scenario for me.
All right, thanks, Max, for sharing your perspective. So the next question by Chan is that what is the earliest sign that we can spot a company could be delisted from the market?
I think normally they will fall into a few category. I think GN2, GN3, GN2, GN3, and also PN16, PN17. PN16 is something fresh maybe for the participants here. Basically, that means that PN16 or GN2, that means that the company, they dispose their core business. Now that the company, they have a lot of cash in hand, right? But of course, they were also given a time frame to secure business and to to buy a new business in order for the company to keep operating, because there's no point for a company with only holding cash to be listed status, right? So GN2, GN3, PN17, PN16, these are the indications that this company might get delisted. Normally, before delisted, they will get through a process of suspension of shares, which is also another good indication of delisting. And also, they will go through the PN17 GN3 status, which is a huge red flag. But again, I know people will argue that, hey, Capital A is doing the same thing. It subjects to their regularization plan, whether it's accepted by Bursa or not, or for cash company basis, whether they can secure a reasonable business for them to take over in that case. Because for main market PN16 companies, it's not easy for them to just buy any random companies as a core business. I think there are some more lenient requirement in terms of hitting the profit requirement for main market. So it's not that easy also.
All right, I think that's all the time we have for question and answer today. So thank you so much, Max, for doing this very engaging Q&A session with all the audience today. Thank you so much, Max.
Thank you.
All right, so let me take over the screen control. So before we conclude today, I would just want to talk about My Bursa. So My Bursa is the latest platform that Bursa Malaysia developed for retail investors. So if you head to www.bursamalaysia.com, you can click this top right corner, the Explore My Bursa button. So once you click the My Bursa button, so I think the current phase now is beta versions where we have got Bursa Malaysia has integrated a few resources for you here. We have knowledge where it will link to Bursa Academy. Where we have market, it could link to a Bursa Marketplace. And on this My Bursa, there are also tools such as heat map and also the screener that can help you to navigate the market better or help you to screen, okay, the potential stocks that fit your investing criteria. So for example, under the screener, you can use the filter, okay? The filter is categorized into financial, fundamental, and also technical. So technical means all the technical indicators. You may find stocks that meet, certain change. Today is up, 5% or up 10% today. Financial, you can pick stocks that have grown revenue year on year, maybe it's above 10% per year, or profit year on year 10% per year, or P is below, above how much. So you can put in all the value here, and then you can punch in your criteria, and you click submit. Then all the stocks that meets the criteria will appear on the screener. So this is how you can use My Bursa screener to help you to perform screening to find the stock that meet your investing criteria. So this is a screener and also heat map that will give you a visual representation of what is happening in the market today, which stock is the market moving stocks, and then how much market size or market cap that they command. All right. So with that, I would like to end the session now. So this is for this session, navigating red flags in the corporate governance of Bursa Malaysia. So thank you, Max, for sharing with us in this session.